Hello, my name is Natalie Lewis. I'm a Senior Vice President with JS Held. We are a global consulting firm that combines technical, scientific, financial, and strategic expertise to advise our clients. Today, I'm going to discuss indicators of potential internal fraud. And to start off with, I'll go through some fraud statistics. The Association of Certified Fraud Examiners, the ACFE, estimates that companies lose approximately 5% of their revenue each year to fraud. They found that the median loss for fraud cases is approximately $117,000. It is estimated that approximately 21% of fraud cases have a loss of over $1 million apiece. Employee theft costs businesses approximately $50 billion every year. And 57% of fraud is committed by company insiders, such as employees, managers, or even owners, or is a combination of insiders and outsiders colluding together. So with this, we'll discuss how internal fraud is damaging an organization. It's not just the financial losses that occur that damages the organization. While these numbers are shocking and the financial loss does make a huge impact, it also damages their reputation, and there's a loss of trust within the company by employees, as well as a loss of trust from the stakeholders and customers and vendors outside of the organization. It also impacts the company culture. Many employees who have gone through an employee fraud within an organization may lose all respect for the organization and leave the company. So what are these common red flags? I find it interesting that ACFE found that 85% of fraudsters they surveyed displayed at least some red flags, behavioral red flags of the fraud. And so some of these red flags that you need to be aware of, and I will comment that just the existence of these red flags does not guarantee that fraudulent activity is occurring, but you certainly want to look further at the situation, that a combination of the red flags and some evidence on the books and records may pinpoint that you have an issue within your organization. So to start off with, the first three common red flags we'll discuss are unusual financial transactions, unexplained inventory discrepancies, and missing or altered records. With unusual financial transactions, you may find frequent or unexplained adjustments. There may be write-offs to revenue that are higher than normal. You may see irregular or unauthorized transactions. Some of these may be expense reimbursement transactions that hit an employee's expense reimbursement claim. And these T&E expenses, you need to look careful to see, is there documentation? Because there may be with these missing or incomplete financial documentation that would also cause unusual financial transactions. You may see unusual patterns of financial activity, such as spikes in expenses, revenue, or write-offs. With unexplained inventory discrepancies, it's necessary to make sure that you are looking carefully between what you have recorded as inventory on your balance sheet and the physical inventory counts that are occurring during the year, especially at end of year. And also look at missing or stolen inventory items, as making sure you have careful internal controls, which we'll discuss later on, to prevent inventory from somehow walking away from your organization. Now, with missing or altered records, there may be deleted or altered records without a legitimate reason, or suspicious gaps in records or missing documents, such as missing checks. Look carefully at these and make sure you do a gap analysis periodically throughout the year to make sure you can account for all of the checks. The next three common red flags we'll discuss is lack of documentation, tips and whistleblower reports, An unusual vendor or customer activity. The lack of documentation could be missing or complete or incomplete records for transactions, specifically cash and/or inventory. Also, altered or forged documents such as invoices or receipts. These would be what you would often find have somehow been modified. Next, we'll talk about tips and whistleblower reports. So I find it fascinating that the ACFE reports that 42% of frauds are discovered through a tip with a whistleblower. And often, more than half of the tips actually came from inside the organization from employees. So it's crucial that your organization has an anonymous tip line where employees and/or external sources can provide these anonymous tips or whistleblower reports. And unusual vendor or customer activity. Look carefully at suspiciously close relationships that an employee may have with vendors and/or customers. You want to look at payments to vendors or customers that are outside the normal business practice. And I will say that with COVID, a lot of companies found that they were doing business with vendors that were not normally vendors that they dealt with. Because of the supply chain issues, this may occur. So just the evidence of a new vendor is not a red flag. However, look at it carefully in the context. The next 3 common red flags are the employee's behavior, an employee facing financial pressure, and extreme overtime or after-hours work. So an employee's behavior, this is often what you think of with a fraudster, and this could be drastic changes in an employee's lifestyle or behavior. You may see expensive spending, such as some of their clothing choices or a new vehicle, you're hearing of a new car, extravagant trips, things like that you want to kind of keep your ears open for. And resistance to vacation or time off. This could possibly be an employee who is trying to cover their tracks. They do not want someone else sitting in their place when they're absent, looking at what they are doing day to day and possibly uncovering fraud. You also want to look at unusually close relationships that an employee may have with a vendor or customer. So an employee facing financial pressure, everyone deals with something, unfortunately, that may come up. However, some employees who are already kind of on that fence of bad behavior may find this as the tipping point where they're able to rationalize fraudulent activity. So look at employees who are facing financial difficulties, whether it be high debt or bankruptcy, gambling habits or other vices, possibly a sick family member, or even a divorce. Also be on the lookout for employees who are expressing frustration or dissatisfaction with their compensation. If they find that they're not able to get a raise or a bonus, these employees that are already having that tendency to sway toward fraudulent activity may find that they are able to rationalize their bad behavior if the opportunity exists. And with extreme overtime and after-hours work, these are employees who are working unusually long hours or nights and weekends. And while there may be seasons within your organization where this is necessary, for some employees who are bad actors, this is also their opportunity to be in the office where others may or may not be around or paying attention, to which they're able to commit their fraud. The final common red flags is an employee's unexplained wealth or extravagant purchases, improper segregation of duties, and unnecessary control over transactions. Now, we touched on the employee's unexplained wealth or extravagant purchases. You want to look for an employee who is suddenly displaying signs of wealth or extravagant spending that is out of proportion to their income. There may be a legitimate reason for this, whether it's an inheritance, but look carefully if there's not, especially if they happen to be in the accounting department or have some sort of access to the company's financial assets. Also look at improper segregation of duty. A company's internal controls is one of the most important aspects of an organization to protect them from internal fraud. Of that, segregation of duties would be at the top of the list. And this is making sure that you have segregated certain crucial aspects of a business so that there's checks and balances in place. And you want to make sure that you do not have the same person with too much control. They should not be able to report or record a transaction, approve it, and authorize and reconcile that same transaction. One person having too much control over a financial transaction from start to finish could make your company vulnerable to fraud. And the final red flag is unnecessary control over transactions. This is when an employee who is consistently insisting on handling specific transactions or specific processes without proper oversight. Some of the main areas that you see this occurring in is payroll and accounts payable. So be careful with these areas specifically and have high scrutiny of who's involved and that proper segregation of duties. So again, a disclaimer, evidence of these red flags alone is not a guarantee that fraudulent activity is occurring or has occurred. However, if it's present, you certainly want to look further into these areas, especially if an individual is involved in the accounting department or has oversight of financial aspects within the business. Some of the recommendations to prevent internal fraud. So I would say strong internal controls would be at the top of my list. You want to make sure that you are looking carefully at this. And as we've seen high turnover with many organizations, you want to look carefully at your organization as you're experiencing these high turnover periods and make sure that you're not finding yourself vulnerable to fraud because of weakened internal controls, possibly an area of segregation of duties that has slipped due to a change in personnel. You want to conduct regular audits and reconciliations, and it's always important to foster an ethical culture. Having a solid tone at the top that is being pushed down, that the company does not tolerate fraud, is going to help set your organization up to be stronger and have employees who are more willing to provide a tip or a whistleblower report if they see fraudulent activity or become aware of that. So with this, I want to thank you for joining me and for having me. Thank you so much.